When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today. And for all the tomorrows to come, ILG's Financial Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to the Retire Your Way podcast with Dave Lopez, the founder of ILG Financial. Wherever you are today, thank you very much for listening. Thanks for joining us. My name is Ryan Stutz, and I look forward to spending a little time with Dave here. And we're going to talk about getting you to and through retirement. And Dave, it is great to be back with you.
It is. It's good to hear your voice, Ron, and I look forward to this podcast today.
We have a lot to talk about today, and first of all, let me put Dave Lopez's phone number out there, 540-720-5656. That's 540-720-5656. Or you can simply go to the website anytime, ilgfinancial.com. You can listen to previous podcasts and whatever resource you need, you can find it right there at ilgfinancial.com. Well, we talk about income, legacy, growth, so many things all the time with Dave Lopez. And Dave, I know recently there's been a lot of talk about taxes and the changes to come. Dave has talked a lot about what to expect and how they can impact your retirement. But there's another side to heavy taxes that isn't talked about quite as often, and that's how these coming tax changes can affect your legacy, what you want to leave to your heirs. Whether you want to leave everything you have to your kids, charity, or Uncle Sam, it's entirely up to you. But you've worked hard your whole life to accumulate what you have. Don't you think you should get to make the choice as to where your wealth goes after you're gone? Dave, can you break down how to handle our estate if we want to pass it on to our heirs without being absolutely slammed by taxes?
Absolutely, Ron. Now, remember, the first caveat is there is no way to avoid taxes entirely. So really, we're talking about mitigation, right? How to legally reduce your tax burden by using rules that the IRS has already put in place. And you want to know that nobody wants to pay exorbitant taxes if they can legally avoid it, right? It's sure. Nobody's choice but yours, though, what to do with your legacy. And that's the key of today. Understand as we go over some simple examples of different ways to transfer. Today, we're going to be talking about transferring the home you live in to your heirs. Understand there is no right or wrong answer, right? But what you do need is you need the facts of what will happen depending on the course you take if you choose to leave your home to your kids or your grandkids. And you also want to be clear in advance before you take action how what you do will affect how the kids and the grandkids have to deal with the IRS down the road. Because the fact of the matter is that the rules that the IRS and the federal government put into place are law. And they're law whether you realize them or not, or take advantage of the loopholes or not. And unfortunately, leaving something to your children, nepotism, is no exception in the eyes of the IRS. So let's jump right in and take a look at some of the options available to you. By the way, as a precursor, if this tax part is of interest to you, if you go onto our website and look for our podcast from May 7th, that episode, Ron, is 5 tax hikes that may be coming your way. We're talking a little more about taxes and a different issue. So with that said, let's kind of jump right into it.
I know that recently, every conversation I have with someone, they're concerned about taxes going up, especially with the way things are right now, coming after the pandemic and all that kind of thing. And it seems inevitable that taxes are going to go up. We want to pay our fair share, but we don't want to pay more than our fair share.
Yeah, you've hit the nail on the head there. And that's why you're hearing on our end more podcasts about this topic, because our podcasts are a result of the questions our clients are asking. And we, like you, are getting more and more inquiries as to things like, Dave, I believe taxes are going up over time. Are there steps I should be taking? And today is another example of some steps you could take. What we're going to do today is we're going to talk about some different options, Ron, different options available if you want to leave your house behind to your kids. Now, keep in mind, every situation's different. Mm-hmm. So as we go through these options, realize there is no one-size-fits-all solution. But the key here is that there are solutions for you. What we need to do is work together, or you work together with our firm or another financial professional to find the right one for you and your family. So with that said, Ron, with your permission, let's jump right into option one.
All right. Sounds good.
Option one is you can just let your child inherit your house when you die. That's the default option. This option comes into play if you do nothing. Now, that doesn't mean it's a bad option, but there could be some limits to your solution if you do that. So when transferring the property at death, the government imposes an estate tax on you. Now, that's a tax that your child will receive on, in this case, the house. After the house taxes have been paid, then he could keep the house. If he can't afford to pay the taxes, he may have to liquidate the house to pay them. Now, it's important to know there is an exemption on that tax. It's called the Unified Federal Gift and Estate Tax Exemption. And currently, it gives each person, as of 2021, $11.7 million in exemptions, or for a couple, $23.4 million in exemptions. So that's a lot of fancy talk, right? All that means is this estate tax that you may have to pay, or your kids may have to pay when they inherit your house. If your estate, including your home, isn't worth more than $11.7 million, then they can inherit your home and, for all intents and purposes, won't have to pay a tax. So that's a good first start based on where you are.
And I would certainly assume that most people would fit into that category.
Yeah, most do. Now, however, what you do want to keep in mind if you're doing that may be the default solution for most, right? It's very simple. Right. The kids inherit the house. There is no tax. And one of the reasons that there is no tax is because they're below that 11.7 million figure. But as we've talked about in previous podcasts, the current administration has said that they want to lower that 11.7 million exemption. And lowering it to what? We don't know yet. So you want to be aware that you could lose that, or your kids could incur some extra taxes down the road if you die after this exemption has been lowered. Let's say it's lowered to 5 million and you have an estate of 7. Now you're going to have to pay tax on that house. What if they lower it to 1 million? So that's something you have to factor in and we can talk about. Another thing to remember is the fact that they won't have to pay not just estate taxes, but they don't have to pay any income tax on the appreciation of this house over your lifetime, Ron. That's called a step up in basis. We've talked about it in previous podcasts. It means that, Ron, if you bought your house for $10,000, owned it for 70 years and sold it for $200,000, there's a profit of $190,000 there, right? 200 minus the 10. When you die and your children inherit the house, they get a step up in that basis, and the basis goes from the $10,000 you paid up to the $200 it's worth at time of death, which means they could sell it the day after and pay no income tax. If you're under 11 million, they're also going to pay no estate tax. Now, why that's important is because the Biden administration has said one of the things they would like to do, whether they accomplish it or not, time will tell. They want to get rid of that step up in basis. So if they do, and you take this option number 1, and the step up in basis is gone, your children may, even though they don't have to pay estate tax because your estate's worth under 11 million, Ron, they may still have to pay tax on the gain of that house over your lifetime. So part of this decision is going to be making your bet on whether the government gets rid of the step up in basis over your life.
Wow. A lot of uncertainties right now. And, if they get rid of that step up in basis, I mean, that's going to make a huge difference for so many people out there.
Yeah, so one of the ways to get out of that, if you're worried about that, then the option might be maybe I give the house away now, right? Well, we can take advantage of the of the lower tax rates, or just get it into the kid's name now so they don't have to worry about it. So that's option 2. Just gift the house outright to the kids right now. Mm-hmm. And we have worked, as you know, Ron, with hundreds of retirees over the last 12 years or so. And I can tell you many, if not most, don't have the desire to live in the family home that they raised the kids on till the day they die. Many want to just move on and move to Florida or move, someplace fun and enjoy their retirement. But some, even though they want to do that, do want to keep the house in the family, sure. Right? So gifting the house to the kids is a popular option, but there's some caveats you need to be aware of. And the first one is that the IRS says that the giver of a gift, that's you, must pay gift tax on that. If you're giving the house away, the recipient, your child, does not, but you have to pay tax if you're giving the gift away. Mm-hmm. And it's going to be anywhere from 18 to 40% tax that they're going to have to pay, but you can still apply that gift tax exclusion, right? That is currently $11.7 million for you and 23 for a couple. Mm-hmm. You can apply that towards the tax. So if you don't want to pay the tax, you can use part of that $11.7 million exemption, gift the house to your kids today, and neither of you are going to pay any tax. And it just lowers the amount that at your death can be exempted from estate tax.
Gosh, there are so many things to be aware of, and most people aren't. And that's a good idea to talk with Dave Lopez, your financial advisor, the founder of ILG Financial. If you'd like to have a conversation with Dave one-on-one, it is 540-720-5656. And as always, you can go to the website, ilgfinancial.com, and get all kinds of information there. Dave, this is really an interesting conversation, and I dare say most people aren't really aware of the things that you're talking about in regards to taxes.
No, they're not. That's the whole point of this, is the takeaway from all of our podcasts, which, Ron, you're well aware of, right, is get informed. Get the data so that you can make an educated decision. Mm-hmm. Even if your choice is to do nothing, at least now it's based on up-to-date and pertinent information as opposed to a hunch or something that your neighbor told you. You're never worse off by having more information of your options. And in a best case, you get educated into an option that can dramatically save you or your heirs money down the road. That's something that you couldn't have taken into effect or taken advantage of. It's a better way to say it, right? Because you didn't know about it.
Well, these techniques certainly are helpful for folks, and it does not mean that paying taxes is totally unavoidable, but and not every solution applies to everybody. But what can you do in order to do this thing in the most tax-efficient way?
Well, like we talked about, it's going to be different for different folks. The gifting of the house outright has some advantages, right? The kids get it now. Since the $11.7 million exemption is in place, that money counts towards that exemption. Right? Mm-hmm. If they lower the exemption later, let's say down to $5 million, well, the money you've used towards this credit towards that exemption, right? Let's say that you give the kids the house for $500,000. That $500,000 lowers the $11.7 million exemption to $11.2 million. Does that make sense?
Yes, absolutely.
Well, if they lower the exemption by the time you die to, $5.7 million, mm-hmm. Well, the $500,000 that you've already gotten credit for will lower that 5.7 down to probably 5.2. So either way it happens. And so you're getting the exemption. It's not saving you necessarily down the road with respect to this. It's just taking advantage of that exemption now. The drawback to gifting the house, mm-hmm. Remember we talked about that step up in basis when you die?
Right.
Well, if you gift the house today, then the price that the house is valued at today and the child receives as a gift becomes their basis, which is in effect kind of a step up, right? But if you live 20 more years and the house appreciates from $500,000 to $1 million, if you had died and given it to them, they would have appreciated the $1 million home and paid no taxes. If you gift the house to them today at $500,000 and they die down the road, and when you die it's worth $1 million and they sell it the next day, they're going to show a profit of $500,000 because their basis is now the $500,000 from the day you gave it. So it's give and take. There's not a right answer, right? Yeah. It just it's knowing the options. So those are really the first two options.
Okay,
right?
Well, go ahead. It's really clear that this is a difficult road to navigate, and it's also clear now what you meant, Dave, when you said that all of these options can apply to people in a very different way. I will say those options also sound extremely generous What about the folks who either don't want to get their house entirely or may need the money from the sale of their house, even if they wish they could leave it to the kids? Are there options for those people?
Yeah, absolutely. So that happens a lot, right? We want to take advantage of the money in the house, but we still want to ideally leave something to the kids or something like that. So that's option 3. Option 3 would be financing your child's purchase of the house. So with this option, you can sell your house at its full fair market value to your child. A lot of times we see families prefer this choice because it's affordable for both the parent and the child, but it keeps the house in the family along with all the memories, especially if the kid wants to live in the family home.
Oh, yeah.
Now, instead of demanding full price for the house at the time of sale, what you can do to make it attractive for your child is you can offer them an installment sale where they pay you over time for the house. That means that your child can afford to pay a low down payment. Let's say they put 10% down on the house, they pay to you, and then you can create a note like a mortgage, right? But you're the mortgage holder. Right. You create a note for the remaining value on the house. Now, if you do that, this is important. You need to make sure the note is written and it explicitly expresses the monthly payments that your child has to make. And keep in mind that you have to charge at least what's known as the affordable federal rate in interest. It's better known as the market rate. Now, this is a great time to do something like that because the rate is, under 2 or 3%. So the kids could lock in on a ridiculously low interest rate to pay you back. So you wouldn't have to charge them a lot of interest. So as long as the note's legal, as long as that note is secured by the house, right, recorded on the deed, and your child makes their monthly payments and interest payments on the house, then they can actually deduct the interest payments as qualified mortgage interest when they're doing their taxes, right? Now, the result of that is you're going to have to pay tax on the interest income you receive from your kids. So that's an option to get the house to the kids and have them take it over instead of trying to qualify for a mortgage with another house, but get into your house.
Now, if you're thinking about doing that, definitely, as you mentioned, this is a good time to do it because, who knows what interest rates are going to be in the future.
Yeah, that's right. A lot of times what happens is you want to get out of your house, right? Your kids are looking to buy a house, but most folks know in this environment, boy, not only is it hard to buy, but what if the kids can't qualify for a loan in the traditional sense? They don't make enough or they've got bad credit. Well, none of that matters if you're the person giving them the loan. Right? So they can get a loan from you. Yeah. They don't have to qualify. They're not competing with some other buyer. So, where they can get the house if they don't mind living in their family home. They get the house that they want. They get a mortgage as good as one that they would get through the bank. And you're getting paid over time if you can afford to take payments that way. So that's option 3.
Yeah, if you're interested in talking about any of these solutions, you can call this number 540-720-5656 and have a conversation with Dave Lopez at ILG Financial, 540-720-5656. A lot to unpack here, and Dave would be glad to sit down and talk about all these things with you in a way that anybody can understand exactly what he's talking about here. And as we go along in this conversation, I'm learning things about taxes, and certainly I hope you are as well. Dave, you've talked about 3 different solutions here. How about option 4? I know there has to be one.
Yeah, there is. And this would be one that comes up a bit. Someone says, I'm going to help my kid out and I'm going to sell him my house, but at a discount. So it's a house he couldn't normally afford. So if you aren't interested or you are unable just to gift the house to the kids financially, but you still want to have the house and hopefully not hurt the kids' savings accounts too badly in the process, this seems like a great solution, right? Sell them the house at a discount. They can get in at a good price. It's your house. You should be able to sell it to whoever you want for whatever you want, right?
It sure seems that way.
Seems so, but not according to Uncle Sam, right? If you sell your house to a perfect stranger, Ron, and you sell it for less than fair market value, then you can write off the loss, right? It was a bad sale, a bad investment, and the IRS is fine with that. They don't care because it's what they call an arm's length deal. And what that means, it's fancy talk, but it just means that the transaction is between a buyer and a seller who act independently of each other. They don't have any other connection without one party influencing the other. So to put it shortly, it's what's called a fair and equal trade.
Yeah.
Now,
and
if you
sold it to somebody who's not really close to you.
That's right. You guys have no other real connection.
Okay.
You're just making a deal. If, on the other hand, Ron, you try to sell the house to a relative for less than fair market value, the IRS says, no, that's a gift. All right. And they won't let you take a loss on the sale, right? That's what they consider a related party sale.
Mm-hmm.
And what they'll have you do is they'll have to say, hey, the difference in what you sold it for and what it's worth, that part is a gift. And you either have to pay gift tax on that, which we talked about earlier, or you have to use part of your annual, your gift tax exclusion, right?
Right.
Against this gift. Now, with this option, right, one of the drawbacks to this, of course, if the house is lower, the child's basis now is lower, right? Remember, we're losing that step up in basis down the road, 20 or 30 years if you're lucky enough to live that long.
Yeah.
When the kid finally sells the house, your child sells this home, his basis will be based on what he took this house over or bought this house for, even at the lower rate. So the lower the sale price, the lower his basis, which means down the road, the higher possible tax, depending on the situation.
My goodness, yeah, that could make a big difference with capital gains.
Yeah, and again, it's possible that if he lives in the house, currently there's an exemption on houses you live in up to $250,000 in gains, $500 for a couple, but that could go away in the future. So, a lot of unknowns, which is why we keep harping on this idea that there is no definitive right or wrong answer right now on solutions because the future is so unsure. But the tiniest difference in your financial situation between you, Ron, and your neighbor could mean the same solution could dramatically play out differently for the two of you.
Well, certainly you're making some very good points here, Dave, and you're listening to the Retire Your Way podcast with Dave Lopez, ILG Financial. And Dave, I think there's a lot to learn and process with all these options that you're throwing out here. But what if somebody isn't ready to leave their house yet, but they want to make sure it's legally set up to be passed down?
Yeah, that's a good one. So that would be what we'll call option 5. You could sell the house to your child, but continue to rent from the child, rent it back from the child. You want to ensure that your child inherits the house in this situation. Mm-hmm. Their name is legally on the house. You continue to live in it. This could be a good fit. Okay, so what you do is you could, let me say it this way. What you can't do is just go ahead and change the name on the deed without running into obstacles later, right? We know that the IRS can't make it that easy for us, right?
No, certainly not.
So you can do one of two things, right? You can sell the house to your child at fair market value, like we just talked about, and then rent it back from them, right? As long as the sale and the rent are at fair market rates, this is a completely acceptable deal, right? You're paying fairly for the rent, the use and occupancy of the home. And because you're doing that, your child may even be able to claim various rental property deductions, right? It's just a rental, right? Something to note, though, is if you go this route, make sure that you enter a proper sales contract and it's documented on the house, as well as a bona fide lease agreement between you and your child. The IRS is going to be paying very close attention to that transaction. And if you didn't do the paperwork as if you would have done it for an independent third party, then there's a chance that they may disallow it.
I get the feeling that the IRS pays very close attention to everything we do.
Yeah, they do. So that's option number 5.
Okay. All right. How about option number 6? Sounds like you have one.
Yeah. So this will be the last one for time's sake that we address today. So when I say this, know that there's a couple, let's just say modifications for any of these options. So there could be more if you were talking to your accountant or your attorney and they said, well, there's some other options. There absolutely are. For time's sake, we're hitting the main ones. Number 6 would be, and we hear this a lot, can I put my house in a trust? And you absolutely can do that. Today, what we'll give you an example of is putting your house in what we call a qualified personal residence trust. It's a way to pass the house on to your kids. This needs to be what's known, Ron, as an irrevocable trust. Now, whenever you hear that, again, that's fancy lingo. All that means is you're putting it into a trust, and that's kind of set in stone. You can't now take the house back out of the trust, right?
Okay.
So you put it into an irrevocable trust. It's a great way of passing your house on to your child while you're still living, and it addresses some of these things we've talked about before about either giving your house to your kid now, which could affect their basis, or waiting later and now the house is worth more and their basis is higher when you give it to them. So the first thing you do here is you create a trust, transfer the house into it. You would name the beneficiary of the trust. In this case, it would be your child. And then you set, this is interesting, a term limit on the trust. So in this case, let's say it's 10 years.
Okay.
That's the specific number of years in which after that 10-year period, in this case, the property would pass on to the child, to the beneficiaries. So the house for that 10 years remains in your name through the trust. You make the mortgage payments. You're able to continue living in the house until the end of the 10-year period, until the end of this trust term limit. And after the term ends, the house automatically transfers into the name of the child. And now, if you want to stay living in the house like before, you would start paying fair rent to the child to continue to living in the house. Okay. Make sense?
That makes perfect sense, yeah.
Sounds good. There's a catch, right? When you transfer the property into the trust, of course, it's like giving it away, right? So it's now treated as a taxable gift. So you would either pay a gift tax based on the value the day you put it into the trust, or you would claim that amount against your future gift tax exemption, just like we've talked about before. But you're doing it at what we are guessing is this lower value, because the house in today's dollars, we're hoping and thinking are going to be worth less than down the road when you died. So you could give the house to the kid today, just like if you gave it to him, it's going to be taxed on today's gift when it went into the trust, not 10 years later when he takes over property. So on the plus side, Ron, you're transferring the house at a lower value than what it was actually worth down the road when you die, right? You're still able to live in the house for many years, in this example, 10 years and more if your child agrees to rent to you after that. Okay. So here's one of the catches. You've got to live longer than that trust term, that 10-year term in our example. If you die before the term's up, the entire value of the house gets included in your estate, just as if you hadn't done anything, just as if you hadn't set up that trust. So it passes to the kids. Again, you can still use the exemption, right? The $11 million exemption. But it's applied towards the value at, the year you die, not the value when the trust was done. So if you outlive that term limit, that's when it really kicks in. And I think the takeaway here is, remember, this is a great way to possibly mitigate down the road estate tax. And that's, again, tax you're going to pay over a net currently $11.7 million.
And of course, so if you're taking a little bit of a gamble because you have no idea how long you're going to live and whether you're going to outlive it.
Right. And you also have no idea if they're going to change that, right? This is historically, this $11.7 million the Trump administration put into place is historically over double what it's traditionally been. It's traditionally been as low as, 1 million, 3 million a person it's been at. And it's, I think right before President Trump, if I'm not mistaken, it was around 5 million before he doubled it plus. Yeah. So historically, it's not going to be unreasonable to assume somebody with a stroke of a pen drops that 11 million to 5, for example. Nobody knows what'll happen. So, we're all making guesses and taking gambles. But again, if your estate is well worth, below, 5 or 4 or $3 million, then you may not have to go through all these machinations. Just let the kids inherit it. If hopefully the step up in basis is still there, take advantage of the step up in basis when the kids when you inherit it, and then avoid estate tax altogether because your estate's worth less than the exclusion that's available to you.
Dave, I have learned so much in this conversation, and it all sounds rather complicated, and I know you keep up with these things, and most of us don't. So, Dave, even if a certain option seems like the best path for a specific family, as someone who may be listening to this podcast today, how do we make sure we're jumping through all the correct hoops and checking all the boxes?
Well, that's a great question. So the takeaway is you need to sit down with your financial professional and you need to build out a plan and walk through how this is going to work based on the current tax code and then based on you and your financial professional's best guess of what you're predicting is going to happen in the future. No two situations are the same, Ron. You know that. We've talked about that enough. And even if two people choose the same option and they're going about it in very different ways, you could have different outcomes, right? So the answer here is to recognize the whole purpose of all of these podcasts is now you know, right? Now you know there are solutions and there's many of them. So call our office. Let's figure out which solution might be the best fit for you. Talks about the pros and cons of each. And then you can build it into your comprehensive retirement plan. This is just one of many parts of your comprehensive plan that ideally you want to address, and we can help you with it here at ILG Financial, and we'd like to.
Dave, let me just say, I've certainly enjoyed this conversation today. I've learned a lot, and I know that all of the folks who are listening to this have as well. I would recommend that they give your office a call right now, 540-720-5656. Of course, anytime to find out more about all these different situations and scenarios, go to ILGFinancial.com and connect with Dave Lopez that way, ILGFinancial.com. You can also listen to the podcast. You can listen to previous podcasts and all that sort of thing. It's an educational experience. ILGFinancial.com. Good website. Once again, the phone number, though, is 540-720-5656. 540-720-5656. Well, Dave, until next time, have a good time, and I will look forward to talking to you again soon.
You too. Have a great time, and thanks for joining me.
Information provided is for educational purposes only, and it is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities.